Well, hello there. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
So, you've got this passion, right? Something you absolutely love doing in your spare time. But when does it cross that line? You know, the line from being just a fun hobby to a real actual business. And maybe more importantly, how do you set it up from day one to be smart about taxes? Well, that's exactly what we're going to break down today.
We're starting with this quote because, let's be honest, the idea of making your passion official can be, well, a little terrifying. All the talk about taxes, paperwork, maybe even audits, it can feel like this huge wall standing between you and your dream. But what this reminds us is that the freedom you're chasing, the freedom of being your own boss, is waiting right on the other side of that fear.
And to help you climb over that wall, we're going to follow a simple 5-step path. First, we'll figure out if you've got a hobby or a real business. Then, we'll cover how to make it official. After that, we'll get into mastering your records, understanding the key tax rules, and finally, planning for some serious, tax-efficient growth.
All right, let's dive right in. Step 1 is all about tackling the biggest, most fundamental question you have to answer at the very beginning. Is this thing you're doing a personal hobby or is it a commercial venture?
See, in Canada, the Canada Revenue Agency, or the CRA, draws a really clear line in the sand here. And this isn't just about what you decide to call it. Getting this right is the key that unlocks everything else, like your ability to deduct expenses or claim business losses. Seriously, getting this clear from the get-go is the foundation for your entire business.
And the whole thing really comes down to this one idea: reasonable expectation of profit. Let's call it REOP for short. Now, think of it this way. The CRA doesn't expect you to be rolling in cash on day one. Nope. What they're looking for is a credible blueprint. They want to see that you're acting like a business and that you have a believable plan to actually make money down the road.
So what kind of stuff makes a tax auditor's ears perk up? Well, this slide is basically their checklist. If you're losing money year after year, if you're mixing your business cash with your personal grocery money, or if you can't even show them a simple plan for how you're going to find customers, they're probably going to call it a hobby. And that's a huge problem, because it means all those expenses you were planning on deducting could get tossed out, leaving you with a very nasty surprise tax bill.
Okay, so you've decided, yes, I am building a real business with a real plan. Great. So, how do you prove it? That leads us straight into Section 2, laying the proper foundation and making this thing official in the eyes of the tax authorities.
You know, I really love this way of looking at it. Think about starting your business like you're a rookie stepping up to bat in the major leagues. You could have all the talent in the world, but if you don't know the rules of the game, you're just going to strike out. Knowing the tax rules before you start is how you set yourself up to win.
Now check this out, because this slide is super interesting. It actually pinpoints the exact moment your business legally kicks off. It's not when you have that brilliant idea in the shower. The clock officially starts ticking when you take real commercial action. See that? Just thinking about business opportunities is a no. But actually buying materials to sell something? That's a big yes. And this date is critical because it's the green light to start deducting your expenses.
And that brings us to this point. And honestly, if you only remember one thing from this whole section, make it this: open a separate bank account for your business, get a separate business credit card. This is not just a friendly suggestion, it is the single most important thing you can do to prove to an auditor that you are a serious commercial operation, not just a hobbyist.
Okay, foundation is laid, finances are separate, now it's time to get into the daily habit that protects everything you've just built. We're talking about mastering your records, the daily grind.
Now here's a little twist on a concept we all know. In the world of taxes, you're not exactly innocent until proven guilty. The burden of proof is 100% on you, the taxpayer, to prove that every single number you put on your return is correct and legitimate. Your documentation, that's your only defense. And this right here is your first and best line of defense: a daily business journal. Just look at the level of detail. It's tracking meetings, tasks, mileage, even that $5 coffee with a potential client. This isn't just a fancy to-do list, people. This is the running story of your business, and it gives you the evidence to back up every single deduction you make.
And in that same vein, if you use your personal car for business, keeping a detailed auto log like this one is completely non-negotiable. You've got to track where you went, why you went there, and exactly how many kilometers were for business versus personal trips. Without this log, any vehicle expenses you try to claim are basically built on a house of cards.
All right, you are now keeping fantastic, rock-solid records. But what are you keeping them for?
That brings us right into Section 4, where we're going to dig into the specific tax rules that all those records are meant to support.
Okay, one of the biggest and costliest mistakes new entrepreneurs make is confusing these two things. This slide makes it crystal clear. Operating expenses are your day-to-day costs, stuff that gets used up within a year, and you can usually deduct 100% of it right away. Capital costs, on the other hand, are for big-ticket items that last, like a computer or a company van. You can't write off the whole cost at once. Instead, you deduct a piece of it each year over its lifespan. That's a process called capital cost allowance, or CCA.
Now, I know this framework looks a little intimidating, but don't worry. You can really think of it as your complete tax roadmap. It basically boils down to three main areas. First, how you track your money. Second, how you categorize your spending, separating those daily costs from the big-ticket assets. And third, and this is so important for home-based businesses, how you draw that clean line between your business life and your personal life. That's where things like your car and home office expenses come in. If you can get a handle on these 7 points, you are golden.
So let's get practical. Here are some awesome real-world examples of what we're talking about. If you sell makeup, you can't deduct the cost of the products you use on yourself. If you're a mason, the bricks for your own backyard patio are a personal expense, not a business one. And for your car and home office, you have to prorate everything, gas, insurance, hydro, based on the percentage you actually use it for business. You have to be ruthless about stripping out that personal portion.
And that brings us to our final section. We've talked about the rules and staying compliant, so now we get to shift gears. We're moving beyond just surviving an audit to actually planning strategically for growth and making your business as tax efficient as possible. Honestly, this is where the real fun starts.
The legal structure you pick for your business is one of the single biggest decisions you'll ever make. And as you can see from this chart, it's all about a trade-off. A sole proprietorship? Super simple. For tax purposes, you and the business are the same thing. But that also means you have zero liability protection. If your business gets sued, your personal assets, your house, your savings, they're all on the line. A corporation, on the other hand, is more complex to set up, but it creates a legal shield around you, protecting your personal finances from any business troubles.
And that choice of structure has a direct impact on how you actually get paid. As a sole proprietor, it's easy. The business makes a profit, you get taxed on it. That's it. But in a corporation, you actually become an employee of your own company. You can pay yourself a salary, or you can take dividends as a shareholder, or even a mix of both. That separation gives you incredible flexibility and some really powerful ways to plan your income and lower your overall tax.
And please, whatever you do, do not forget about the value of your startup losses. Look, most new businesses lose money at first. That's normal. But a business loss isn't just a loss, it's a financial tool. As you can see here, a $10,000 loss can actually be carried back to a previous year when you had other income, and it could generate a $4,500 tax refund. That's real cash back in your pocket right when you need it most.
So, when you put it all together, what have we learned? Running a tax-efficient business isn't really about finding some secret loophole. It's about writing a clear, consistent, and convincing story. Your detailed records, your separate bank accounts, your smart choices about structure, these are all just chapters in a success story that's professional, legitimate, and totally audit-proof. The only question left is, are you ready to start writing yours?